In the context of financial markets and trading analysis, a window refers to a gap indicating a space between two adjacent candlesticks on a chart. This gap represents a price range where no trading has taken place, essentially highlighting a sharp move in prices either up or down within a short time frame. Windows can be seen as significant indicators for traders, as they often signal the strength of the current market trend or a potential reversal. Moving beyond the window, it is crucial to comprehend the messages these gaps convey about market sentiment and future price movements. If the price gaps upward, it may suggest strong buying interest and a bullish outlook. Conversely, a downward gap could indicate selling pressure and a bearish sentiment. Traders often look for the subsequent market activities post-window to confirm if the initial jump or drop in prices would sustain, marking it as a potential indicator for setting their trades. Understanding windows within trading charts is not just about recognizing the gap, but also about analyzing their context within the market conditions. This includes looking at volume changes, the time frame of the gap, and the overall market trend. Each of these factors can provide traders with insights into potential market movements, allowing them to strategize accordingly. Being equipped with this knowledge, traders can use windows as part of their toolkit to decipher market dynamics and make informed decisions in their trading endeavors. The four-price doji is a concept in technical analysis that highlights a unique situation in the financial markets. This occurs when the opening, closing, high, and low prices of an asset are either the same or very close to each other within a particular trading period. It signifies an extremely tight trading range, often pointing to a moment of indecision among traders and investors regarding the asset's value. Introducing the mystery of the four-price doji requires an understanding that this pattern is not merely about the numbers. It reflects a pause in the momentum where neither buyers nor sellers are in control, leading to a deadlock situation. This can be envisioned as a moment on the battlefield where two equally strong armies face each other, but neither moves. The balance is so delicate that any new information could tip the market in a new direction. Understanding this concept is essential for those engaging with the markets, as it can serve as an indicator for potential volatility. Following a period of indecision, markets tend to move sharply once the deadlock is broken. Recognizing a four-price doji pattern could, therefore, help predict sudden changes in market trends, making it a valuable tool for those looking to develop informed trading strategies. Identifying the four-price doji involves recognizing a specific pattern on a price chart. This pattern indicates a period of extremely low volatility in the market. The four-price doji is unique because it shows that the opening, closing, high, and low prices for a given time period are virtually identical. To spot this pattern, look for a candlestick on the chart that appears almost as a thin line. This thin line signifies that the price of the asset hardly moved from the opening price by the time the period closed. It represents a moment of indecision among traders, suggesting that neither buyers nor sellers could gain the upper hand during that period. The significance of the four-price doji lies in its rarity and the potential market implications. It might signal a pause before a significant price movement, as after a period of indecision, the market could be preparing for a breakout in either direction. Therefore, identifying this pattern can be crucial for traders who are trying to gauge market sentiment and anticipate future price movements. In practical terms, to effectively identify a four-price doji, one should closely monitor price charts and look for the characteristic thin line candlestick. It requires paying attention to the details of the price movements throughout the trading day or the specific time frame one is analyzing. This pattern can serve as a tool for predicting market shifts, making it an essential concept for those engaged in technical analysis of the financial markets. The four-price doji is a term used in technical analysis that denotes a scenario where the open, close, high, and low prices are almost the same for a given time period. This indicates a very tight trading range, showing that there is a near equilibrium between supply and demand. This pattern helps traders and investors understand market sentiment by revealing periods of indecision where neither buyers nor sellers have enough confidence to move the market in a significant direction. When it comes to deciphering market sentiment, recognizing a four-price doji can be quite insightful. It suggests that the market is in a state of balance, but also highlights potential instability, as a slight increase in demand or supply could lead to significant price movements. Understanding this, alongside other market indicators, can provide valuable insights into future market trends, helping investors make more informed decisions. By closely observing these patterns, traders can better gauge the mood of the market, preparing themselves for any sudden changes in direction that may occur following such a period of uncertainty. The term four-price doji refers to a specific pattern observed in the trading charts, indicating an extremely tight range of trading activity. In this pattern, the opening, closing, high, and low prices are virtually the same. This reveals a state of equilibrium between buyers and sellers, demonstrating that neither side has a definitive advantage at this point in time. Moving on to the concept of pattern classification. A crossroads, it describes a critical juncture in the analysis where the outcome of the identified pattern could signal multiple potential directions for future price movements. When a four-price doji is observed, it signifies a moment of indecision in the market. Analysts and traders closely watch for this pattern because it suggests that a significant price movement could be imminent once this equilibrium is disrupted. To put it simply, when you come across a four-price doji in a trading chart, imagine it as a quiet moment before a storm. The market is pausing, creating tension as both buyers and sellers await a signal to determine the market's next direction. This scenario highlights a critical decision point where the subsequent price action will indicate whether the market will trend upwards, downwards, or continue in a ranging condition. Understanding these patterns and classifications helps traders to make more informed decisions by considering the potential for significant shifts in market dynamics. The four-price doji is a unique pattern in technical analysis that signals a period of extremely low volatility in the market, where the opening, high, low, and closing prices are nearly identical. When encountering this pattern, it is essential to look for key factors for confirmation to make informed trading decisions. First, the volume of trading during the formation of a four-price doji is a critical indicator. A significant drop or unusually low trading volume can reaffirm the pattern's validity, indicating a lack of interest at current price levels and potentially signaling an upcoming increase in volatility. Second, the context in which the four-price doji forms is equally important. Identifying it within a trend or range-bound market can help assess future movements. In a steady uptrend or downtrend, a four-price doji might suggest a temporary pause before the trend resumes. Conversely, in a range-bound market, this pattern might indicate consolidation, with a breakout likely to follow. Lastly, preceding and succeeding candlestick patterns should be analyzed. The appearance of a four-price doji between strong directional movements may hint at a temporary balance between buyers and sellers, with the dominant market force likely to take control soon. By considering these factors, traders can better interpret the four-price doji, using it as a tool to anticipate future market movements while assessing risk and opportunity. This approach combines an understanding of market psychology with technical analysis, enhancing the decision-making process in trading activities. The four-price doji is a term used in technical analysis that suggests a period where a security's open, close, high, and low prices are almost the same. This indicates a very tight trading range and suggests a level of indecision or equilibrium between buyers and sellers. When it comes to the reliability and interpretation of this pattern, it's important to consider it in the context of market conditions and other technical indicators. The very nature of the four-price doji, showing minimal price movement, hints at a pause in market momentum. This can sometimes precede a significant market move, as the equilibrium suggests that neither bulls nor bears are able to take control, leading to potential volatility when one side eventually dominates. However, on its own, the reliability of this signal can be considered low due to its rarity and the short time frame it represents. Investors and traders often look for confirmation from subsequent price action or other technical indicators before making a trading decision based on a four-price doji. For instance, if the four-price doji occurs after a strong uptrend, it might signal that the buyers are losing steam and a reversal might be imminent. Alternatively, if it appears during a downtrend, it could suggest that selling pressure is waning, potentially resulting in a bullish reversal. In both scenarios, additional confirmation is advisable to enhance the decision-making process. In sum, while the four-price doji provides a snapshot of market indecision, its interpretation requires careful consideration of the broader market context. A four-price doji is a term used to describe a particular scenario in financial markets. It refers to a situation where there is a very tight trading range. This means the opening price, closing price, highest price, and lowest price over a given time period are all virtually the same or very close to one another. This pattern is indicative of a market in equilibrium, where the forces of supply and demand are balanced. A four-price doji is recognized in technical analysis as a sign of indecision among traders about the future direction of the market. Integrating a four-price doji with other technical tools is a strategic approach for gaining more comprehensive insights into market sentiment and potential movements. Other technical tools can include trend lines, moving averages, and momentum indicators. For example, if a four-price doji forms near a key trend line or a significant moving average level, it could suggest that there is considerable uncertainty among investors regarding whether the market will respect that level or break through it. Similarly, if a momentum indicator shows divergence, i.e., it is moving in a different direction to price, spotting a four-price doji might signify a potential reversal or continuation of the current trend depending on the broader market context. In essence, combining the observations of a four-price doji with other technical analysis tools can offer more nuanced interpretations of market dynamics. This integrative method assists traders and investors in making more informed decisions by providing a clearer picture of market sentiment, potential shifts in momentum, and areas of support and resistance. It is a testament to the layered and multifaceted nature of financial markets, where no single indicator provides all the answers, but rather a tapestry of clues that, when pieced together, reveal a larger story. The four-price doji is a term in technical analysis that indicates a period where the market's opening, closing, high, and low prices are virtually identical. This pattern suggests a very tight trading range, reflecting a state of equilibrium or indecision among traders about the asset's value. During such times, the volume of trading is typically low, and the market seems to be waiting for a catalyst to prompt a move in either direction. In the section regarding common missteps and misinterpretations, it is crucial to remember that while the four-price doji signifies market indecision, it should not be viewed in isolation as an indicator for making trading decisions. One common mistake is overemphasizing the importance of this single pattern without considering the broader market context and other technical indicators. Traders might incorrectly assume that a doji automatically signals a market reversal. However, without corroborative evidence from additional analysis, acting on this assumption can lead to premature or misguided trading decisions. For example, if a four-price doji appears after a lengthy uptrend, it might tempt traders to predict an imminent downturn. However, without confirmation from other indicators such as volume patterns or moving averages, this prediction could be faulty. Similarly, in a downtrend, encountering a doji might spark expectations of a recovery, yet the trend could persist if the broader market conditions remain unchanged. Therefore, while the four-price doji provides valuable insights into market sentiment at a specific time, it is essential for traders to integrate this information with other analytical tools and market data to form a comprehensive view. This approach reduces the risk of misinterpretation and enhances the decision-making process in trading activities. The four-price doji is a notable pattern in technical analysis, indicating that the trading range within a specific period is very tight. In simpler terms, this means that the opening, closing, high, and low prices during this time frame are virtually identical. This pattern signals a state of equilibrium or indecision among traders, suggesting that neither buyers nor sellers are in control. It is a moment in the market where there is uncertainty, and a significant move can follow in either direction. When discussing strategies for entry and exit points in the context of the four-price doji, it's essential to treat it as a precursor to potential volatility. Since the pattern points to a tightly contested area, the strategy should hinge on awaiting a clear signal that indicates which way the market leans. This could involve monitoring for a breakout in prices beyond the narrow range defined by the doji. A breakout, defined as a price movement beyond the tight trading range, often signals the direction of the next significant move. Entry points should be considered when there is a clear break above or below the range with increased volume, indicating buying or selling pressure that could drive prices further in that direction. It's wise to set exit points or stop-loss orders just outside the range of the doji to protect against loss if the market does not move in the anticipated direction. Setting these safety nets helps manage risk, a fundamental aspect of trading strategy. In summary, the four-price doji points to a period of indecision, and strategies surrounding it should focus on identifying the direction of the market's next move. This involves careful observation of price action following the doji and setting clear entry and exit points to capitalize on or protect against subsequent movements. A four-price doji is a unique pattern found in the study of technical analysis, representing a situation where the opening, closing, high, and low prices of a security are nearly identical. This particular phenomenon points to a very tight trading range, indicating a period of remarkable stability or indecision among the market participants. Typically, this scenario unfolds in markets that are experiencing low volume or are awaiting significant news or events that could impact price directions. When we explore variations and related patterns, it becomes evident that although the four-price doji is rare, its appearance draws attention to the balance between supply and demand. Similar patterns, often referred to as kin, include the common doji, where the opening and closing prices are equal, and other variations like the long-legged doji, dragonfly doji, and gravestone doji, each differing by the length and position of their shadows. These variations serve as cues to investors about potential shifts in market sentiment. For instance, a long-legged doji signifies a great deal of indecision, as prices move significantly higher and lower than the opening price, but close near it. The dragonfly and gravestone dojis hint at potential bullish and bearish reversals, respectively. Understanding these patterns and their implications allows investors to make more informed decisions, considering how such tight ranges or sudden shifts in sentiment could unfold into larger price movements. In essence, recognizing a four-price doji and its variations is valuable for investors steering through uncertain markets. It acts as a precursor to potential volatility, enabling strategic decisions to mitigate risks or capitalize on upcoming opportunities.